Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Andrew Sheets of Morgan Stanley in the soft landing camp. Soft landings don't have to play out in a straight line. This is a tricky window where risks around growth are skewed to the downside. A few false negatives in the data can lead to bouts of volatility. Andrew joins us now for more. Andrew, welcome to the program. Let's start with that phrase, soft landing. What does it mean to you?
Good morning. It's great to be here. So for us, it means inflation coming down, the Fed easing, and no recession. And that's very much what Morgan Stanley has been forecasting, what we continue to forecast. And I think that's what fortunately, we've been seeing from the data. I think we were in a critical window over September and still in October where, the market's going to be more vulnerable to weaker data because the Fed and the ECB haven't really gotten underway yet with rate cuts. But I think so far that data's come in pretty solid, and I think that supports the soft landing view.
Andrew, you referred to some of the data as a few false negatives potentially in our future. Can we talk about the data we had through the summer and at the other side? Which one was the head fake, the deceleration in jobs through the summer or the reacceleration we saw on Friday?
Yeah, so I think it was potentially this kind of rise in the unemployment rate. And this has been something that's in a lot of focus because, over a long period of time, it's consistently been one of the more worrying cyclical indicators for markets. Once the unemployment rate is rising, it's almost kind of too late. At that point, that's one of the last indicators historically to crack. And at that point, it's very bad for equities and credit. And I think that's what the market was concerned about. You had concerns about triggering the SOM rule. You had concerns that the unemployment rate was already going up. And yet the Fed, as of the July meeting, had still kept rates on hold. Now, there was another view there, and that was the view closer to the view of Morgan Stanley's economists, which is that the unemployment rate was giving somewhat potentially kind of misleading signals because of the shape of the labor market, the fact that participation was actually quite strong. That was kind of confounding the picture a bit, but we really didn't know. And even, heading into the other week with the latest non-farm payroll number, you had a really wide set of expectations going into that number, an unusually wide set. So I think the number we got was good. We were at 160,000 at Morgan Stanley. We got a better number than that. And also, I think, given some of these very kind of unfortunate and tragic natural disasters that we're seeing in the U.S., that could make the next several data prints more uncertain. So I think the fact that we got one solid reading for the economy or another solid reading on jobs is quite helpful for, I think, assuring the market that for now the economy is still in an okay place.
Even with those prints, it's interesting to look, Andrew, at how Fed language hasn't changed. They are still talking about a balanced approach. Balanced is the new buzzword. Collins said it yesterday. Jefferson said it too. And we have an Atlanta GDP Now tracker at 3.2%. If it is a Fed that is still biased to cut with a strong economy, how positive is that for risk assets?
Yeah, so we do think we're still in a good is good environment. You mentioned correctly, we also follow that Atlanta Fed tracker. We think it's been a great indicator recently, and it is suggesting a very strong U.S. economy. But I think the other important thing is inflation is really looking like it's getting back under control, that kind of the battle against inflation has been won. And if you look at forward-looking inflation expectations from the interest rate market, say over the next 2 years, those are kind of below. Those are implying a number below what the Fed is targeting. So if we think about kind of historical performance patterns, certainly historical patterns for credit, a scenario where the economy is holding up better, where the Fed is cutting more gradually towards neutral, which is, what we're forecasting at Morgan Stanley. We think from this point on, they're doing 25 basis point cuts. That's been a much better kind of trade-off for risky assets than one where growth is weakening more and you're getting a lot more Fed cuts. So I think the scenario that we're getting in the data is very much tracking closer to that better soft landing base case.
That scenario you lay out, it's happening in the Treasury market. That repricing has happened since Friday. But Andrew, in the corporate credit market, the repricing hasn't happened. Investment grade spreads are still at 83 basis points, exactly where they were on Friday. Are you surprised by the resilience, the unmovedness of this market?
Well, look, spreads are tight, but our view at Morgan Stanley has been that spreads should be tight, that we're in an environment of better than expected fundamentals. We think a soft landing is an unusually good backdrop for credit. Credit likes moderation. A soft landing is all about moderation and growth and inflation and monetary policy. And you still have very good technicals. You still have very strong demand relative to supply in the market, and better than average fundamentals, better than average technicals probably should mean, tighter than average, richer than average valuations. So I think another important factor, and I'm glad you linked it to yields, is we do think we're in an environment where higher yields are good for spreads, that higher yields are bringing in more demand from insurers, from pension funds, from a lot of the buyers who've been really driving the market over the last year. And so, with yields going up to 4%, all of a sudden that same spread, hits a lot more yield bogeys for those buyers.
Andrew, right now we're dealing in an environment where there's a number of potential risks. In the United States, there's the politics. Potentially we're not going to know for days, weeks, and we could see a contested election. Then there's the geopolitics. We've seen the short-term increase in the oil price. What is the biggest catalyst to potentially your soft landing scenario?
Well, I do think, understandably, I think the U.S. election is going to and will get a lot of that focus. I think you are facing a close election. That's one important factor. And between two candidates with very, very different policy agendas and policy proposals. And so, I think in terms of thinking about factors that are not just going to affect the market over the next month, and we are, less than a month away from the U.S. election, but also really going to potentially affect how investors think about pricing into next year. I do think the U.S. election probably stands out as a really important factor. And that's why certainly, at Morgan Stanley, we've been devoting a lot of our effort to trying to understand the issues around it and research related to election implications.
Do you think the market right now is properly hedged for a scenario where the election might be contested?
Well, I think it's difficult to say. I mean, I think we have seen some increase in volatility around the month of November, but it's also a factor where this is an issue. I mean, I'll talk about the election more generally. That is a kind of a known unknown heading into next month. The markets had this on their calendar for a long period of time. I think a lot of investors in our meetings cite the election as a major source of uncertainty. So, I do think as much as it's fair to say that the election is bringing up the potential for volatility, is bringing the potential for uncertainty, I think it's also possible, it's also fair to say that investors are very aware of this and that they're going in with their eyes open. Now, again, I think it's a factor that we also, when we look out into 2025 and, again, we're pretty optimistic, say, on more M&A activity in the market. We actually think that moving past the election, just kind of having this, once this question is resolved, that can be a positive catalyst in certain ways, that can help, we think, trigger more corporate activity, and that there are some, some risks associated with it, but also some positives as you move past the event.
You're not the only one who said that. Andrew, appreciate it. Andrew Sheets there of Morgan Stanley. Dawson of NewEdge Wealth saying we would not be surprised to see continued volatility in the near term as risk assets are going into this historically high volatility month priced for perfection. The volatility is unlikely to be cataclysmic given the backdrop of strong economic growth and a shift to more supportive monetary policy. With a very long word, Cameron Dawson joins us now for more. Easy to write than say out loud, Cameron. Thanks for that.
I put it in just for you.
Thank you very much. Let's talk about this run we've seen in some of these individual names. Nvidia's had a massive run, 5 days of gains. And for some people, they're reflecting on the first half of this year, where we had this big boost in inflation, turned out to be a bit of a head fake. We started to think about high rates for longer, and tech stocks really started to perform. Are we reaching for that playbook all over again?
It is interesting to see the equal weight S&P 500, which has been doing better over the last couple of months, start to roll over on a relative basis, which just suggests that maybe there's this narrowness creeping back into the market. And you see it within the tech sector itself. Look at Nvidia being strong, driving semiconductors, but flip the page to software. Microsoft is breaking down. It's now below its 200-day moving average. So even within the all-great tech sector, there are pockets of weakness being held up by just a couple of names.
Is this all about rate cut expectations? Is that in the driving seat, or is it something else?
We think it's the confluence of everything. If you take a step back and appreciate the fact that you have strong economic growth, look at Atlanta Fed GDP now at 3.2%, supported by fiscal deficits as if we're in a crisis, now with the bond market pricing in the largest non-recessionary cutting cycle in 40 years, what are risk assets not to like? And we think that's why you see credit spreads so tight. The BAA credit spread is now 100 basis points, nearly at the lows that we saw in 2021. Equity valuations 21.5 times. That's at nearly the highs we saw in 2021. So these markets are priced for perfection, but that's because the backdrop is quite nearly perfect. The question is, can it last and where does it go from here?
Does earnings season help with expectations of under 5% growth year over year? That's relative to what we've seen before, kind of a low bar.
It is a low bar because you've also seen those estimates get trimmed going into this earnings season, so maybe we can jump over this lower bar. The thing that's interesting is over the last 2 months, you've actually seen 2025 estimates get trimmed as well. We think that's why markets have stalled out over the last couple of months. They've been relatively flat. So you do need to see earnings estimates continue to rise, we think, in order to support the market. The one thing that has been the key underlying support for this market since the beginning of 2022 is rising 12-month forward earnings estimates. That is absolutely critical to maintain.
And you've seen that in 72% of the companies, that's according to Bank of America, are expected to grow their EPS. That's some good breadth. But as John was just describing, the market doesn't have breadth at this very moment. Do you expect that to change?
It's certainly the hope of a lot of people. And if you look into next year's earnings estimates for 2025, the market has priced in the Mag 7 decelerating materially and the rest of the market accelerating in their earnings growth. But in a way that actually creates a high bar for the rest of the market to deliver because you have these big accelerations in earnings growth, which are already priced in and forecasted.
So the banks report on Friday, and we're all reflecting on what we heard maybe 2 weeks ago when we heard from Ally Financial warn about credit risk, and we heard from Dan Pinto of JP Morgan, who talked about lower interest rates maybe weighing on net interest income. What do you think is going to be the standout theme for this reporting season for some of the banks, both big and small?
I think it all comes back to the credit risk question, which is the underlying question that we've all been asking. Is the economic data overstating the strength of this economy? And the message from the banks will be important because they'll give us a notion about small businesses, they'll give us a notion about consumers, and if we continue to see credit risks bubble up, look at default rates within consumers. That's what Ally was flagging back a couple of weeks ago. If you continue to see that, it would question some of this headline data necessarily not being as strong as maybe it looks on the surface.
In the weeds a little bit, Jack Caffrey at JP Morgan mentioned this yesterday. It's very unusual to see defaults on auto loans. If you go back to GFC, I remember all the stories we'd tell. The car was the last thing. It was the one thing you held on to. You always made that payment. What could that be about?
It's partially a function of the price increases that we saw coming out of the pandemic. It's partially a function of people reaching for cars coming out of the pandemic. But it also likely reflects the true K-shaped economy. It's usually the lower income consumer that's more likely to finance their cars and have floating rate debt overall with credit cards. We do know that the low income consumer is under pressure. And the one thing that is keeping them above water is this jobs market. It's pretty incredible that you're seeing this huge uptick in defaults with a relatively robust jobs market. Look at where the unemployment rate is. If that goes up any higher, this could actually have defaults in that cohort of consumers that would be in line with the GFC, even though consensus seems to be that we're not going to have a consumer-led kind of recession this cycle. So I think it is incredibly unique, but it is certainly something that catches our eye that makes us question the data.
That is one of those things, again, just out of line with an economy that's been driven by consumer spending. You also see it in some of these companies. In just the past month, Pepsi, Constellation, Nike, FedEx, RH, Hormel, Dollar Tree, Lululemon have all cut their sales or earnings. Again, just in the past month. Is there a sector, because this has continued to be a problem for this equity market, of staples, of packaged food companies that you just can't buy until we figure out what's happening with the consumer?
I think it's all a reflection of this fading pricing power, and that comes squarely to head with what we're seeing within forecasts for earnings, because earnings are forecasted to actually accelerate next year on the revenue line. If you see fading pricing power, companies effectively saying, we want to raise prices, but consumers are pushing back because they can't take it anymore, that suggests that you'll actually see a deceleration in revenue next year, which is certainly not what's being priced in.
Does that cap just how bullish you can be on an overall equity market, which with otherwise has good fundamental growth in the economy behind it.
We don't think it would be the end of the world or a too reaching of a base case to expect relatively flat returns in 2025. It's not enough to say get out of your equities and run for the hills. It's just to appreciate that if that 12-month forward earnings number starts to flatline, it's likely that returns flatline. It looks a lot more like a year like 2015 or 2018 where the market chopped sideways, and the good news in that is it effectively allowed you to grow into very fulsome valuation multiples, which is where we are today.
Cameron, I hate to be the Debbie Downer, but what if Tariff Man comes back? What if forward earnings actually look like? For these companies?
We didn't necessarily see it impact company earnings in a material way in 2018 because it was far more pocketed. If we have broad tariffs, though, this is certainly something that could challenge the earnings picture because we do know it's effectively a regressive tax. We do know it does lower consumption. It's less of an inflation risk and more of the fact that it would dampen consumption, which then, of course, would cause you to question earnings estimates, and that would be a source of volatility for equities.
I meant to the Debbie Downer on the earnings estimates. Do you think companies are going to have to focus on this in this quarter because it is just around the block in terms of what this election is going to look like?
We've already been hearing from companies over the last, let's call it 3-4 months, that they've been delaying some capital spending. They've been delaying some hiring decisions because of election uncertainty. So certainly that is something that's weighing on their mind, whether or not they're going to absolutely make changes because of the election going into this earnings season. They'll probably say we have to wait and see.
Think about how wide the range is for 2025. A sweep for either side. We could have a corporate tax rate of, 28% on the one side and 15% on the other with conditions. What does that look like for you? Just how wide is the range for 2025?
Completely massive. And I think that what we have to appreciate is that both sides, what they have in common is that they're talking about higher deficit spending and growth dampening policies. So on one side, you get growth dampening from tariffs and potential immigration. The other side, you get potential growth dampening on higher corporate taxes, which just means that we then have to turn our minds to the bond market. And how does the bond market digest all of this? We do know that the bond market did not like the higher Treasury issuance in the third quarter of 2023. Treasury yields went up by 150 basis points and valuations within the equity market hated it. So we do think that instead of this idea of buy the rumor, sell the news with the election, that the election itself could be a source of volatility if it results in a sweep.
That could be cataclysmic. Cameron, thank you. Did I do that right?
You got
I think
it.
I did.
Yeah.
Thank you. All right, second go. Cameron Dawson of NewEdge Wealth. Cameron, thank you very much. So here's the latest. FEMA bracing for Milton's landfall. Already stretched thin following Hurricane Helene, the agency is preparing for a $3 billion deficit by February. But the government says it has the resources to meet immediate needs. The former FEMA Administrator Craig Fugate joins us now. He led the agency under the Obama administration. Craig, thank you for giving us your time this morning. We recall also some of the work that you did with Governor Jeb Bush back in the early 2000s, and maybe we can start the conversation there. Of the hurricane seasons that you oversaw in 2004, 5, 6, when you think back to that period, what's different about the hurricane seasons now that we have to confront in Florida?
Well, I think we're just seeing rapid intensification that we haven't seen before in history. So when you look at going back just 10 years, how many storms went from a tropical system to a Category 5 hurricane in less than a couple of days? And so, I think we're having to just get ready for these more intense hurricanes as they're approaching and maybe not have the lead time. The good thing about Milton is there's been a lot of time to get ready. In fact, many people started evacuating as early as Sunday. So this is a little bit different than a storm that just popped up. They had time to get ready, but it will not reduce the impacts.
Craig, let's talk about the FEMA response. Are they prepared?
Yeah, I get this question a lot. And as bad as Helene was, FEMA has a lot more resources, a lot more capability, and they're not going to have to stop the response in Hurricane Helene. That's, I think, a big concern for people in that area, that while the national media has focused now on what Milton's about to do, FEMA is still working and supporting the governors in the states that have already been hit. And again, the priority in any of these disasters will be always life-saving, life-sustaining, and getting communities stabilized to set the stage for long-term recovery.
FEMA recently said, though, that they have only 9% left of their personnel reserves. That's about 1,200 people. Where do they look then in terms of getting the bodies they need to go to these areas that are going to be hit?
Well, those numbers really refer to staffing required for long-term recovery. The initial response teams reset between disasters. FEMA has a lot of capability to reprioritize their resources, as well as deploy people from the headquarters. We did this in Superstorm Sandy. If FEMA needs to, and given the size and impact of what Milton looks to do, I would imagine there's going to be a lot of people redeployed across the nation to support the state of Florida.
Is the current funding enough, or do you think Congress is going to be forced back into session and get off the campaign trails?
Well, right now, FEMA does have money to do the initial response and provide support to the survivors. I think the bigger question is going to be the level of funding required for long-term recovery, the permanent work, and that's not just going to be FEMA. There'll be a lot of federal agencies that will need additional funding to support the recoveries from these previous storms and disasters, as well as what we're about to see with Hurricane Milton.
And it's not even just those storms, Craig. Before it was wildfires out west that also required FEMA money. So you get to this point, as John mentioned, a $3 billion deficit. Does there need to be a structural change with FEMA and its funding to ensure that it can continue to deal with successive climate issues?
Well, this was a situation we actually faced it in the Obama administration, and then Speaker Ryan and at that time OMB Director Jack Lew had come up with a way to increase FEMA's funding, but it was always based upon the past storms, the past disasters. So the problem is, as we get bigger and more intense disasters with little break between them, we really need to look at a funding mechanism going forward. But I think it's critical we understand this is your federal tax dollars. This is increasing cost to the budget that does not seem to be slowing down. It's growing rapidly, and it's far beyond just what FEMA programs are being taxed with. So for the federal taxpayer, we're seeing a tremendous transfer of risk to the taxpayer, where previously insurance covered this. And as the insurance markets are no longer able to provide affordable or available insurance due to these increasing impacts, we're seeing this transfer of risk to the taxpayer, and that's going to grow, and I don't know if we have answers for that yet.
What does that mean, Craig, for when these areas get rebuilt that are still under risk? A place like Tampa also had impact from Helene, now again Milton. When government agencies, when FEMA, when others go in to rebuild these areas, does it need to look different this time because they are under constant threat?
The answer is yes, and FEMA has for a long time been focused on rebuilding better, not just putting things back. But the challenge is we're going to have to not only just put it back better, we're going to have to build it for the future risk. And that isn't going to be inexpensive. The other problem I see is that we're going to increasingly see a transfer of risk to government-run programs like the Citizens Insurance Program in Florida, because commercial insurance is finding it extremely difficult to be able to stay in these markets where it's an affordable product given their extreme exposures.
It's a conversation we had earlier this morning, just devastating. Craig, appreciate your time this morning. Thank you, sir. Craig Fugate there, the former FEMA Administrator.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.